The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. A holiday-shortened week, but still lots of activity.
Consequential.
All right, let's take a look at where things stand in the financial markets. The S&P 500 opened higher and never looked back. It's now up about 1.4%. This marks the second straight day of gains. The Mag 7 leading the way, up 3.5%, with Tesla leading the charge there. And we're seeing lower yields across the curve right now, the 10-year at 4.03%. Yields are kind of stuck in a range with not a whole lot of catalyst coming out before the FOMC meeting on December 10th. And Bitcoin now in the green, up by 0.4%. It did fall below $86,000 this morning after a pretty wild weekend, Katie.
Yeah, absolutely. And overall, Wall Street's optimism when it comes to tech seems to be seeping into risk on appetite, even boosting, as you mentioned, Scarlett, a battered down Bitcoin. Traders seemingly forgetting the volatility of last week, forgetting about AI valuation concerns as tech leads today's rally, sending the NASDAQ 100 up more than 2%. Meanwhile, Morgan Stanley's Michael Wilson joining the chorus of bulls, saying that the recent pullback, it's coming to an end, and also seeing buying opportunity into the new year. But the pullback, it's not inconsequential, with Ed Yardeni saying that those AI jitters means the S&P 500 definitely won't hit his year-end target of 7,000, but that it doesn't mean it won't hit the mark next year.
The air is coming out of the bubble rather than the bubble bursting is in my mind, a very positive development.
Meanwhile, traders get a big clue on the consumer with September U.S. retail sales hitting the tape tomorrow. We also get the producer price index as well as durable goods orders later in the week. And it could mean big things for the Fed that has been driving blind when it comes to data. Money markets pricing in favorable odds that the Fed will cut rates at its next meeting, with Fed Governor Christopher Waller fueling optimism today, indicating that he'd support a cut next month. But Scarlett, we know that this is a hot debate topic right
Absolutely, and it hasn't been resolved, but let's show you how market pricing for that December rate cut has really changed since the last meeting by the Fed in late October. Now, for most of November, and this is the period we're looking at here, hopes for a rate cut were fading, at least confidence in that cut, with this line moving up. Right here was when we got the minutes from that October meeting that revealed that many officials were in favor of keeping rates steady. And the following day, we got a stale September jobs report that showed unemployment rate ticking up unexpectedly to 4.44%. And of course, that renewed concerns about the labor market. In the last 2 days, you've seen a quick move here thanks to dovish comments from Waller and before him, New York Fed President John Williams. And now we're back to seeing almost an entire 25 basis point cut priced in. Katie?
All right, let's kick things off and keep this conversation going with Jim Caron. He is CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management. Jim, great to see you in person.
Good afternoon.
So let's talk about the Fed, because this December meeting, it feels live, the pricing going back and forth here. And I wonder, when you think about this Federal Reserve, all the different cross currents coming, the question of December, the question of 2026, how are you feeling right now?
Well, look, like you said, it's been going back and forth. And let's take a step back. Last week, there was about a 30% probability that the Fed was going to cut 25 basis points in December. Now there's 70. What does that tell you? It tells you that the market has no clue. It is 50-50. I don't care what the numbers say. It is 50-50. Look, it's going to be a close call. I think 2026, though, is going to be a better year to the extent that 2025 is the soft patch. This is when economic data was supposed to slow down. It did slow down, but it was masked by the fact that equities kept making new all-time highs. But the data, it wasn't really that strong. But I do think that there is going to be a recovery in the data next year, and that's going to form the right side of the U and actually, bring things a little bit better.
Well, talk us through what gives you the conviction to say that 2026 will be better than 2025. When you spill out the tea leaves, what exactly do they say?
Lots of headwinds. So number one, you don't have tariffs. Tariffs are pretty much already set in motion. Second is that you ultimately understand the tax policy at this point. So taxes are there also. Inflation. Inflation is not going to be as much of a headwind. We expect inflation to start to come down. So just the relationship between U.S.-China policy, tariffs, taxes, and even inflation suggests that, plus you're going to get an onslaught of fiscal stimulus, whether it's accelerated depreciation, tax policy in that sense, even for the consumer in terms of tax rebates. So a lot of these headwinds that did exist in 2025 are going to go away. The question is 2025 pulling forward all of that good news right now, and is there room to surprise to the upside? And we think there is.
What about the labor market? How does it shape up in 2026?
Yeah, so I do think that the labor market's going to get stronger, but it's going to get weaker first. So if you ask me, I understand that the unemployment rate is 4.4% based on the latest data. If you ask me, I think the real number is somewhere around 4.8 or 4.9. I fully expect us to get there. I have a much, much more sanguine view on labor, but I think it's temporary, and I think it's already here, and it's being priced in. This is the soft patch. So when we start to move into 2026, I would expect that the mid-cap, even the small-cap companies, which account for about 70% of job hiring, with deregulation and everything else and tax policy, is going to be better. So I think we're going to have some weak momentum in jobs coming into 2026, particularly in the first quarter. But then after that, you're going to start to see a recovery, and I think things start to stabilize.
So how does that lead to how you want to allocate your money? Where do you want to be in equities versus fixed income versus something like alternative investments?
So right now we are still more overweight equities than we are fixed income. We think that fixed income, just spreads are very tight. Rates have come down. I think we're already pricing about a 3.5%, Fed fund move down, and Fed policy maybe a little bit lower than that. So I think we're almost priced to perfection in that sense. On the equity side, though, I don't think that we're priced really for what I would expect in 2026 to be more of a broadening of the market, the other 493, not just the Mag 7. So I think equities probably shows the most potential for upside. Private markets are still interesting right now. They're going through some fits and starts. We all know what's going on in private credit. There's a big repricing, a re-underwriting of the risk. Private equity, though, in many cases, has, I think, the pendulum is already gotten down towards the bottom, but you got to be patient. You're not going to get your money back plus a return really quickly, but that's when you want to invest in private markets, because you can't buy when the pendulum's swinging up, because then you're going to overpay. Right now, you can get things at a good discount to NAV, but you got to be patient.
Well, Jim, let me make sure that I understand what you're saying. So you're saying that right now, private equity maybe looks a little bit better than private credit? Yeah,
I think so, in my opinion. Now, you're going to get different views on this, because it always depends on the idiosyncratic factors. Which manager, which opportunities are you looking at? So let's set that aside for a second. But I do think that on the private equity side, that a lot of the bad news, a lot of the valuation arguments, those were in the past years. Right now, I think we're coming out of that. In private credit, we're still hearing more and more talks about this, and there's still a lot of worriness and worry in the markets.
Does that spill over into the public credit markets?
I don't think so. We're not seeing evidence of that. I mean, credit spreads still remain relatively tight. So default risks, in our view, no recession in 2026. Default risks, we still think, stay relatively low. People are yield buyers of credit right now. Spreads are tight, there's no question. Now, we'll make the case that we don't think there's a lot of room for spreads to tighten further, so you're not going to get that excess return, but you should be able to clip the coupon, I think, with some reasonable confidence at this level. So I think it's worth an allocation in that sense.
And Jim, I'm also curious to get your thoughts on cash here, because one of the puzzles of markets this year is that you have equities at all-time highs, risk assets, it feels like in general have had a very good year. And then you take a look at money market funds. I think we're up to, what, $7.5 trillion?
Yeah, sure.
Something close to that, maybe a gazillion soon coming. It just feels like there's this insatiable demand for cash. And I wonder what breaks the fever, basically.
So people have been worried about the markets. Look, whenever you see the markets go up with narrow leadership, what that means is that the markets have become increasingly fragile, which means that if there's a slight vibration, the Jenga can start to kind of come down, right? And you can see that in some of the big name, tech stocks, for example, over the past couple of weeks. So what people are doing is they're allocating away from this fragility in the markets. When the market starts to broaden out, and it's a good question, like what's the catalyst to make people get off the sidelines with cash? They need to see the markets broaden out. It can't just be about 7 stocks. It's got to be about the other 493, because then what they can do is they can start to diversify. They can go into healthcare. Healthcare is interesting right now. Industrial policy is very positive. Materials, that's connected with, so once you can start to broaden this out, people see that they can get the diversification, and that's going to move them off the sidelines from cash.
So maybe 2026. We'll have to check in on that, Jim. Great to spend some time with you. That is Jim Caron. He is CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management. Now, coming up, a discussion on the state of the street. State Street Global Advisors CEO Yie-Hsin discusses what's capturing the attention of investors, particularly in the secondary market, and what she thinks the Fed will do in December and beyond.
Then from Wall Street to Main Street, Deborah Weinswig, founder and CEO at Foresight Research, breaks down the vibes of the U.S. consumer as we head to Black Friday and what to expect from the September retail sales due out tomorrow.
And we'll also focus on where the money really is when it comes to AI. Why Deon Nicholas, executive chairman of Forethought Technologies, thinks agentic AI is the future of tech, and how much more he thinks we'll see in AI spending. All that and more coming up. This is The Close on Bloomberg.
Bitcoin is bouncing around today, but last week really took the wind out of that trade sales. A Bloomberg report out today flagging the connection between Bitcoin trading and President Trump's approval rating. For more on this, let's bring in Bloomberg's Michael Ball, who made the connection. And Michael, this really has to do with sentiment on, what the president is going to do for the industry and where Bitcoin's trading.
Exactly. Yeah, we already had a risk-off tone. We had a more hawkish Fed, which was kind of weighing on everything. Then all of a sudden, we have some stalling in key legislation. And as a result, now you have less of a tailwind from sort of the Trump administration pushing forward this to legitimize the asset class. Now, obviously, Bitcoin's been on quite a run since Trump was inaugurated, since he was even elected back in November. So there was a lot of froth that potentially come out, and drawdowns have been much deeper. So we're not quite at a point where everyone's like, okay, this is one of those longer-term cyclical drawdowns. But we are at a point around 80,000 that we hit on Thursday, that makes people question.
Mm-hmm. Well, Michael, as you know very well, correlation is not causation.
Yeah.
It could be the case that this is just pure coincidence, and wouldn't that be fun? But let's talk through some of the potential reasons here for why this correlation might exist. Because, you think about the Trump administration coming into office for a second time. The idea was that this was going to be a very crypto-friendly administration.
Yeah, right. So the Clarity Act was the next big piece of legislation that passed the House in July. We had the Genius Act, which set some stuff up. Clarity Act was going to give you sort of the classifications of the different tokens and coins and help with who's going to be the regulator for that. And then it was also going to, again, legitimize this as another asset class for big money to come into. And we did see that. Mm-hmm. But now what we've seen is some of the sort of gapping price action in the last few weeks, because this has been going on since mid-October, has kind of made people pull back and wonder again just how deep is this market, how much money can I push through it, and as a result we're sort of in this crypto sort of bear market.
Yeah.
To the extent that there's any fundamentals driving Bitcoin, it seems like one of them is that you have the administration's support, full-throated support. And I think a lot of people in the market are wondering, is there a Trump put? And if it comes in, what would trigger that?
Right, so we're going to see in Q1 if the Senate picks up this bill, but we also need to have this strategic reserve, which is this Bitcoin concept that is kind of stalled out as well. Now, I don't know where that is. I think the issue there was funding, because again, we are conscious of debt issuance to then, move into a digital asset that's not yet been proven necessarily on a longer-term basis. So that's a key thing I think the crypto community is watching. But also, these tokenization of stable coins is happening. We know this. We heard from the banks and the financial systems, and we're seeing even some of the consumer-facing brands start to look into it as something. So it is still moving forward, but again, we might have gotten ahead of our skis a little bit.
Ahead of our skis, just a little bit. And Michael, I want to run a theory by you, because this is something that Romaine and I have been talking about, that when it comes to Bitcoin, the case can be made that it's really useful to keep an eye on, because it's pretty pure when it comes to being a measure of risk appetite. You sit on our Markets Live blog, so you have to watch everything all at once. And when you think about Bitcoin moves and its relationship to other assets, I wonder if that theory holds water with you.
Yeah, it did. And again, we talked about the Fed sensitivity, right? We have a tighter Fed. We have liquidity concerns in the front end, which makes risk assets all weighed down if there's not excess cash. When you heard Williams speak last week, you could notably see the Bitcoin bounce. We obviously saw it in the futures as well as far as equities. But it did tell me that there is this risk pulse waiting to sort of be unleashed there, and that there are sort of dip buyers lurking in the back looking for the macro picture to get more supportive. So yes, it is definitely still a proxy of risk. I think there's been these idiosyncratic stories with legislation, which has taken some wind out of the sails. But every day I see it sort of moving in tandem, and of course on the weekends everyone's watching it.
In your prior life, you worked at the New York Fed for about 4 years, so you're used to looking at all the different market measures. When you look at everything across the board, are you more worried or are you more feeling more confident?
Yeah, I'm happy in a lot of ways that the actual Treasury rates complex has been pretty well anchored in a tight range. I think the dollar is also held in nicely. Where rate differentials are shows me the dollar is probably behaving as it should. But as far as the front end plumbing, I am concerned that there was an over-tightening of reserves and that the Fed will have to come in with open market operations and inject cash. And that's something that they've started to talk to. You've seen Lori Logan, you've seen Roberto Perli, of the New York Soma portfolio, and Williams himself say that there is something that we have to talk about here. And unfortunately, October minutes lacked that conversation. It caught a lot of Treasury desks off guard because they thought it would be more urgent.
Well, we will keep an eye on that, and we know that you are as well. That is Bloomberg's Michael Ball of our Markets Live team. Now coming up, Scotiabank's Louise Chen joins us for the skinny on what's moving healthcare stocks as Novo and Merck head in opposite directions. That conversation up next. This is The Close. All right, it's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And first up, Booking Holdings. Bank of America getting bullish on the name, upgrading it to buy from neutral. Analysts calling the AI-related risks that are sending the stock lower, quote, overdone, and maintaining their $6,000 price target. You can see shares a little bit higher, up about 2%. Next in line, Carvana. Wedbush revving up its rating to outperform from neutral, saying it's prime time for investors to take advantage of weakness in the stock. The price target is now $400. That is up from $380, with analysts saying that the downside is limited. Shares are up more than 7%. And finally, Morgan Stanley. Wolfe Research banking on upside in that name, raising its rating to outperform from peer perform and setting a street high price target of $198. Analysts citing a better revenue outlook and best in class growth. Shares currently up about 3%, and those are some of our top calls. Now, another space getting analysts' attention is healthcare. Merck gaining on an upgrade from Wells Fargo to overweight on optimism for the business beyond Keytruda, its flagship cancer drug. Meanwhile, you have Novo Nordisk lower after two admittedly long-shot studies confirmed that its Ozempic pill is not effective in slowing the progression of Alzheimer's disease. Let's discuss the space overall with Louise Chen. She is managing director over at Scotiabank. Louise, great to have you with us. So you cover Eli Lilly, which is, of course, Novo Nordisk's biggest rival here. And this has been a pretty rough day for Novo shares. You've seen some reaction in Eli Lilly. I wonder if there's anything to extrapolate from their failed trials here, if you want to call it that, over to Eli Lilly.
Yeah, I don't think there's anything really to extrapolate here. I think years ago, Eli Lilly decided they were not going to look at GLP-1s for Alzheimer's disease, and it sounds like that was the right move on that part. So I think the momentum for Eli Lilly continues. They've got a lot of data readouts coming. They have a big year next year. Numbers are going higher because they're launching a oral obesity drug, orforglipron. They now have Medicare coverage, so really exciting times for Eli Lilly and for obesity in general.
Well, that's what I was going to ask, Louise. You take a look at 2026. We know that Eli Lilly has really taken the baton when it comes to who leads in the U.S. obesity market from Novo Nordisk. And you think about 2026, would you say that it's the oral pill that is potentially the biggest catalyst here for this company?
I think in the near term, it's going to be one of the biggest catalysts. And they also have data coming for another phase 3 asset, retatrutide, which is a new mechanism of action. It's called Triple G. And that is speculated to be one of the highest efficacy drugs for obesity. We'll see how that turns out. But that could keep the momentum going for Eli Lilly.
You know, when it comes to that pill version of Ozempic failing to get anywhere with Alzheimer's, I wonder if it's because it was the pill version. The ingredient, semaglutide, is said to be very promising in treating all kinds of other ailments. Is this something that Eli Lilly would look into on its own, maybe test the injections as a possible treatment?
I think Eli Lilly decided years ago just not to pursue GLP-1s for the treatment of Alzheimer's disease. I think they felt it promoted health and what have you, but doesn't attack the core mechanism of action of what causes Alzheimer's. So they have their own drug for Alzheimer's, Kisunla. They're coming up on another study looking at early preclinical Alzheimer's disease. So we'll see if they take forward some of their monoclonal antibodies for Alzheimer's disease.
Okay, great. I mean, I just wanted to make sure that there was no other way that perhaps we could do something with this semaglutide. So, Louise, when it comes to Eli Lilly, we've seen some of the other big pharma companies really try to shore up their drug pipeline because they're losing patent protection on a number of their high-profile drugs. Is Eli Lilly in that boat at all?
Eli Lilly is not in that boat. So we kind of divide our coverage universe into structurally sound companies and companies that are trough valuation because of these loss of exclusivities. And Eli Lilly falls into one of those companies that has great momentum for the foreseeable future.
I also want to talk a little bit about Merck because it's been an interesting couple of weeks for Merck. I know that last week they had a mid-stage trial of a drug for a rare form of high blood pressure. That actually met its main goal. That was a big catalyst for the stock. This is a company that you rate as a sector outperform. You take a look at shares year to date. It is higher, the company, on a total return basis, but it's been underperforming the broader sector. And I wonder, Louise, whether that momentum can continue and actually pick up in 2026 in your view.
Yeah, I do think it's going to pick up in 2026. We really like Merck. And I think what the street is missing is that they do have a patent cliff coming, or loss of exclusivity for their key drug, Keytruda, over 50% of their sales. And I think that they actually have enough in their products, current products, commercial, and in their pipeline to more than offset that. But the street hasn't picked up on that yet. And once they do, as Merck continues to execute, that stock will re-rate. And I think it's going to be one of the best performing stocks in the sector once it does for healthcare.
I'm looking at how pharma companies have performed overall this year, and the group is up about 19%, certainly outperforming the broader market. Where does that set us up for 2026 in terms of investors' exposure to this group overall?
Yeah, I think for many years, people have underinvested in healthcare for all sorts of reasons, a lot of it macro-based, some of it because of the loss of exclusivities that are coming for some of these big companies. But we launched coverage very recently with a sector outperform for the entire sector. And I think what the street is missing here is after many years of underperformance, I think these companies are all on their next wave of innovation, and that next wave of innovation is going to be very exciting because companies are looking to treat to cure. The science is there. They need to execute. They need to get it done. And I think once they do that, people will realize there's so much more value for pharma than there used to be.
And Louise, we only have about 30 seconds off with you, but how do potential political headwinds fit into that picture for the sector? There's been a lot of back and forth, a lot of hot and cold action when it comes to how the Trump administration actually views the pharma and health industry overall.
Yeah. So it's been a noisy year in pharmaceuticals, some positive, some negative, but I think that's more than pricing these shares at this point. And I think anything else that's forthcoming will probably be something that hopefully will be positive for the sector. There are some great things happening. For example, MFN. I think that's interesting for U.S. pharmaceutical companies because of the benefit that they will have internationally from these prices. We'll see if any of these things actually take hold. But that being said, I feel like it's more than priced in, and I think the risk reward is the upside on the political front.
All right, Louise, thank you so much. Louise Chen is Managing Director over at Scotiabank. Coming up, State Street Investment Manager CEO Yie-Hsin joins us exclusively to discuss staking her claim in the secondaries market. It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Katie Greifeld. Keeping an eye on these markets. Just 30 minutes to go until we close the books on this Monday. What a bounce back we're seeing in the S&P 500.
Yeah, although I got to wonder how much volume we're really seeing, given that this is a holiday shortened trading week, and there's not a whole lot of catalysts right now, aside from the Black Friday retail sales number due out at the end of this week.
Exactly, and of course, then the catalyst after that is what the Fed is going to do. That seems to be the hot debate in markets right now, given that we're in a bit of a lull when it comes to the earnings picture. But when it comes to the outlook for 2026, I got the chance to speak with State Street Investment Management CEO Yie-Hsin earlier in an exclusive interview about the firm's perspective on where markets are heading, their recent investment in the secondaries privates markets, and what to expect out of the Fed into year-end and 2026. Here's part of that conversation.
We still would very much like to see a 25 basis point cut from the Fed. We think inflation is more contained. Even though maybe there's higher goods inflation, services are softer in the housing residential sector. And at the same time, we're very worried about the employment picture. Unemployment has ticked up, hiring has slowed down, and consumer confidence is weaker. And so to really protect against this, we'd like to see the Fed take that 25 basis point cut. A little less clear as we move into 2026. We may be not calling for as much as 100 basis points, but somewhere in the neighborhood of 50 to 75 basis points makes sense to us.
I also want to talk about how investors are positioning amid all these different cross currents, because one of the most interesting stories to me, I think, of 2025 is still this red hot demand for cash. You take a look at money market funds, you take a look at cash like ETFs, the lines just keep going up, even though you do have the Fed starting to reduce interest rates here. And I wonder, first off, what you make of that and what will finally break the fever. Is it lower interest rates or is it something else?
Well, the need for income is very significant, and whether that's because of sort of developed economies have aging populations that are looking at cash. Cash is providing multiple uses within a portfolio. It's generating income, it's dry powder should there be a major correction, and it also helps to diversify the overall portfolio. And for that reason, we think cash probably stays at these sorts of levels. May come down, but I think that might need some greater investment opportunity than perhaps investors see today.
It's interesting to hear you say that because I talk to a lot of folks, a lot of investment professionals, and it's the most urgent question they have to answer is how do you get investors out of cash, get them off the sidelines, so to speak. But it sounds like you're saying this isn't necessarily the sidelines. That's not necessarily the way to be thinking about cash.
I think that's right. And what we're seeing is just a continuum of cash, if you will, right? Short-term deposits and money market funds to short duration and the like. And we do see some argument for extending maturity slightly in the short and intermediate term of the curve. At the moment, credit spreads are incredibly tight, investment grade and high yield. And so moving along that sort of treasury spectrum, we think is warranted. But again, it's not the same as a lot of cash moving into the market.
Mm-hmm. And so cash being one of the big stories of this year, so too are private markets. And I know that, of course, in November, you took a minority stake in Collar Capital. That specializes in the secondaries market for privates. What is the plan there with that stake, and how does it fit into your overall strategy when it comes to private markets?
We're very excited about this partnership and ownership interest in Collar Capital. They're one of the very first to develop the secondaries market and have capabilities on private equity and private credit secondaries. And if you look at the broader volume, secondaries are only 1-2% of all fundraising that happens. And so this is a segment that's been growing at 15% per year. We think has a chance to triple in the next 5 years. And so this liquidity aspect and being able to give investors access to already invested portfolios, we think is a really compelling proposition that we're looking forward to introducing more of our clients to their capabilities and looking at what we can do together from a product collaboration standpoint.
Interesting. So when it comes to the secondaries market, it sounds like you're basically trying to position to take a bigger piece of what is a growing pie.
That's correct.
Interesting. And I know that you've said in the past that overall that you would be in the market to buy a private asset firm. Is that still the case?
We're very excited about this acquisition. We'll continue to evaluate if it makes sense to add other capabilities. But for the time being, between our interest in Collar Capital, our partnerships with Apollo, Blackstone, Bridgewater, bringing their really great capabilities to market alongside our ETF strengths, is keeping us really quite busy.
And of course, State Street Investment Management, the first out of the gate with a private credit ETF. And I want to talk about retail demand for private assets more generally, because you think about the turbulence that we've seen in the past couple weeks, of course, when it comes to private credit, when it comes to, for example, Cockroaches and Blue Owl's pooled fund merger. Has that dampened at all retail enthusiasm to get access to some of these private strategies?
I think from where we sit, we continue to see investment discipline in the private credit arena. Defaults may be rising slightly, but from a very low base. And some of the big profile ones we think are more idiosyncratic. And at the same time, there's a secular long-term trend of the private markets providing credit capability and availability, given that the banks are more limited. And so the liquidity aspect, the income aspect of private credit, we see continuing to be in demand by retail investors. One area that we're focused on is in the defined contribution arena. We're one of the largest USDC managers, and we've been first to market to introduce a target date fund with a 10% allocation across private equity, private credit, and real estate. And we think it makes sense for individual investors to really participate in this part of the market that is showing tremendous value creation, yet they don't have easy access.
And Yie-Hsin, we only have a couple minutes left. I have to ask you about ETFs. That's, of course, the sandbox that I play in. the most. And what's interesting is you think about share classes. Dimensional Fund Advisors, for example, last week finally got the green light from the SEC to launch ETF share classes of existing mutual funds. I know that State Street Investment Management has basically asked for the reverse, to launch mutual fund share classes of existing ETFs. Given that approval hasn't been issued yet, let's just talk about what dual share classes, if improved en masse, could mean for the asset management industry and what it could look like 5 years from now when we finally get up to speed here.
Well, for the most part, asset managers are looking to issue ETF share classes off of their mutual funds. And investors will benefit because they won't have two separate vehicles, but they'll enjoy the scale and size and the cost efficiencies with a single asset base. We're a little different. We're a very substantial ETF player. We're also very significant in the retirement arena. And we're excited to be launching mutual fund share classes off of our ETFs, which are already very low cost, very efficient. And by virtue of the ETF structure, we lower transaction costs. And we think that'll be a substantial benefit to so many retirees.
Interesting. So just to tie a bow on that, so basically, if you were able to launch mutual fund share classes, you would be able to put some of your ETF strategies as mutual funds into 401ks.
Absolutely.
And our thanks, of course, to State Street Investment Management CEO Yie-Hsin. Now, coming up on the close, Gemini 3 is becoming a major AI star. Shares of Alphabet are taking off as its newest AI model rakes in the good reviews. It's today's Stock of the Hour, and it's up next. This is The Close on Bloomberg.
It's time now for our Stock of the Hour, and we're looking at Alphabet. Google's Gemini 3 chatbot making a lot of waves in the AI race, sending shares of Alphabet soaring as the Gemini 3 chatbot gets rave reviews. Let's bring in Mandeep Singh, Global Head of Technology Research here at Bloomberg Intelligence. Have you used Gemini 3? What do you think of it?
I have, and look, when it comes to using it with Chrome browser and the family of apps that I use from Google, it is seamless. And you can ask long-form questions, which is the incremental part of what Gemini brings. You could have always done that with search, but I think Gemini gives you the ability to do complex searches. So from that perspective, I don't think it's cannibalizing my Google searches yet.
Well, apparently it changed the life of Mark Benioff. He is, of course, the CEO of Salesforce. He posted on X over the weekend, quote, "I've used ChatGPT every day for 3 years, just spent 2 hours on Gemini 3. I'm not going back. The leap is insane." So where does this stack up as it comes to ChatGPT? What does this mean for OpenAI?
I mean, look, all these models are measured in terms of, different capabilities. I would say if you are doing text-based searches on, general world questions, then ChatGPT may still give you better answers in certain cases. But when you look at it holistically, image generation, visual reasoning, like these are the sort of things where Gemini really shines. And it's not surprising because they have that corpus from YouTube that no one else has. The search index, to me, that is the big differentiator now with Google, because no one else has a real-time search index that Google does. I mean, OpenAI, they have to constantly keep training their models or rely on Bing to give them real-time search. That is becoming more and more obvious because Google results are grounded in their search index.
So I guess that depends on how and when you use your AI as well. If you're using it on your phone versus your desktop at the office. When you're using your phone, you're looking oftentimes at images. Does the iPhone, does Apple have a partnership with either ChatGPT or Gemini?
I mean, look, we know Apple doesn't have their own LLM, and everyone has been asking why are they not investing in infrastructure when all their Mag 7 peers are doing it. And the answer is after the, the settlement, the monopoly hearing that Google had, and, the fact that things are settled now, most likely Apple is going to end up using Google as the default LLM. They're already doing that for search and, a bunch of other apps. Now, I think with LLM, Gemini to me is the front runner. Obviously, Apple has an integration with OpenAI, but it's not native. And that's where the usage hasn't really shown up on an iPhone. So to my mind, I think it'll be interesting to see who pays who, because right now Google is paying Apple $20, $25 billion a year. In the case of Gemini being the default LLM, I suspect Apple may have to end up paying Gemini, but it'll be interesting to see how it pans out.
So 30 seconds here. I want to get a little bit dramatic. If we look into the future, and Alphabet is the clear winner here when it comes to LLMs and AI in general, and OpenAI is a distant second place, what does that mean for all of the different deals that OpenAI has signed on to with pretty much everyone, it feels like?
I mean, everyone wants to double down in terms of building the infrastructure. Google's advantage is their cost of TPUs. They have the lowest cost of infrastructure because of their vertical stack. And to me, that differentiation isn't going away. That's a real moat that they can sustain. That's why OpenAI wants to build their own chips, but it'll take them a while before now they have to defend their LLM turf.
All right, well, the AI race heats up here, certainly, between OpenAI and Google Gemini 3. Mandeep Singh, thank you so much. Mandeep, of course, with Bloomberg Intelligence. Coming up, we take you to the closing bell with Liz Thomas, head of investment strategy at SoFi. This is The Close on Bloomberg.
I think 2026, though, is going to be a better year to the extent that 2025 is the soft patch. This is when economic data was supposed to slow down. It did slow down, but it was masked by the fact that equities kept making new all-time highs. But the data, it wasn't really that strong. But I do think that there is going to be a recovery in the data next year, and that's going to form the right side of the U and actually, bring things a little bit better.
That was Jim Caron, CIO of the Portfolio Solutions Group over at Morgan Stanley Investment Management, kicking off the show, talking about his expectations for 2026. They look pretty good, and certainly it seems like the market right now shaking off its recent volatility.
Absolutely. Of course, it's a holiday-shortened week, so you wonder how much participation there is in this equity rally, with the S&P 500 holding on to the bulk of its gains, adding 1.5%. UBS's head of equity derivative hedge fund sales said that the de-risking is behind us for now. So at least until Black Friday, when we get some of those early numbers, retail sales numbers.
Certainly ominous, that for now there, but let's keep this conversation going right now with Liz Thomas. She is SoFi's head of investment strategy, joining us right now. And Liz, you think about where we are when it comes to the S&P 500. Last week, down 2%. Now, Monday, just a flip of the calendar, and we're higher by 1.5%. What do you think is driving this volatility that we've been seeing as of late?
Yeah, so thanks for having me. So I think first and foremost, we have to really give credence to what's happened with Fed rate expectations. We saw big swings in the expectations for a cut in December. Went from 67% down to almost 30% last week. And then just one tiny comment at the end of the week sent it back up over 60%. Now, last I checked today, we're above 70% chances for a cut in December again. So I think a lot of this is about a liquidity and a supportive backdrop picture for equities and for risk assets in general. Investors had been looking for a reason, frankly, to understand why the market was this high and understand if we should just kind of shake the tree and get some of the froth out of it. And a lot of times when we talk about things being too extended, we end up making it a self-fulfilling prophecy. And I think that's what started to happen for the last couple of weeks.
Well, let's think about why we're seeing these flip-flopping Fed rate cut expectations for December. It seems like when it comes to both sides of the mandate, they're actually in conflict right now, the labor market and the inflation backdrop. And you've been hearing folks from either side, hawks and doves, arguing opposite positions there. And Liz, I wonder which is the more urgent side of the mandate to you right now?
Well, they are in conflict, but it's not as clear anymore. So for a good portion of 2025, we had been hearing from the Fed that they were more concerned about the labor market. And that looked like the right way to be looking at it. It looked like the labor market was weakening much more quickly than inflation was going up. And we didn't really see pressure on inflation, at least not yet. We didn't see pressure on inflation in an upward direction that was that concerning. So it seemed like the right approach to take to be concerned about this weakening labor market. We are without data right now. The last data that we got was for September, and it was kind of a mixed bag. We had an unemployment rate that increased, but perhaps because the labor force actually got larger, not because people lost their jobs. And then we had more jobs added than expected. So right now, if you look at just that data point and just the CPI and PCE data that we have, it's actually not in that much conflict, and it maybe does make sense for them to pause if they wanted to in December, because things aren't weakening very strongly, right? We're not looking at this terrible weakening trend. However, when you look into 2026, what I think the Fed is trying not to do is get ahead of themselves on a cutting cycle and create too much liquidity in a market that hasn't quite solved the inflation problem yet. There is still a chance in the labor market that we see some weakening once we start to get data rolling on a regular basis again. But I think the reason that this December meeting has been such a big point of contention is, number one, we're not going to have good data before then from the BLS on jobs. And we've got a pretty split list of Fed voters. There's not this certainty about who's a dove, who's a hawk, who's in the middle, and what the votes might end up as.
Yeah, there's a lot of division. And to your point about the increasing odds of a rate cut in December, now I'm looking at WIRP on the Bloomberg terminal, and we're looking at 80%. And you have Mary Daly, the San Francisco Fed president, remarking to the Wall Street Journal that she supports lowering rates in December due to the sudden deterioration in the labor market. Liz, how are you thinking about the AI trade? Because as people come back into the market today, there seems to be this idea that perhaps there's a new winner here, at least Alphabet, Google, Gemini 3 is catching a lot of people by surprise, and people are seeing maybe there's a little bit of room here to look for winners beyond the big hyperscalers, the obvious names. I'm not saying that Alphabet's not one of them, but it is an interesting twist.
Yeah, so if we're just talking about the AI trade in general, first of all, I think what's happened over the last few weeks as you saw this risk-off behavior is that investors are searching for other places to find a growth opportunity. So whether that's AI adjacent or maybe some other names that in the future could benefit from AI rather than just the ones that are the headline makers or the Magnificent Seven or the names that we most quickly associate with that trade. I do think it's prudent to widen out that net quite a bit and make sure that you have exposure to other things that can benefit from AI in the future, but also widen out the net of just growth opportunities. And that's another big reason why I think healthcare has caught quite a bid recently, looking at biotech and pharma as growth generators and the opportunity to generate more growth into 2026, but at a much lower valuation and not in this constant conversation about whether or not things have gotten too high. So I do think that broadening out and diversifying the AI exposure is smart for investors.
What about broadening out to other asset classes? Where do you want to be in fixed income?
So fixed income, especially the Treasury curve right now, Treasuries have not been acting the way that you would expect after Fed rate cuts. So I would want to be on the shorter end of the curve in fixed income, and I would be staying away from the really high risk fixed income. Now, of course, it can generate a higher yield, but spreads still remain pretty tight. They've had some of an increase over some of the regional banking stress and risk-off behavior, but they're still very tight, and it's not necessarily something that's that attractive from a valuation perspective, in my opinion. So I would stay high quality in fixed income, shorter end of the Treasury curve.
All right, Liz, great to get some time with you. Thank you for kicking off the week with us. That is Liz Thomas. She is head of investment strategy over at SoFi. Again, we are counting down to the close, just minutes away. It was interesting to hear Liz's comments that when it comes to fixed income, higher quality, shorter duration, and it seems like that's been the trade for a while here.
Yeah, it has been, although you look at the performances and you actually see investment grade return more than high yield, which is a surprise given that you should be getting higher returns because you're taking on much higher risk with high yield. But within high yield, you can look at, the better higher yield versus the junkiest of the junk.
Yeah, and it's a good reminder that when it comes across asset classes, it just feels like valuations are so tight right now. Whether you're looking at the S&P 500, whether you're looking at credit spreads in high yield or in high grade. But we are moving closer to the closing bell. Full market coverage right here on Bloomberg. That starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Scarlett Fu in for Romaine Bosick. And here to help take us through the closing bell, we're joined by a global simulcast, Carol Massar and Tim Stanovic. We bring together all of our different audiences across all the different platforms. Carol Massar, and boy, what a bounce back we're seeing on this Monday.
Yeah, exactly, right? Although you dig a little bit deeper into the S&P 500 and almost an even split, but I am seeing some mega outperformance when it comes to the semiconductor names, up almost 5% in today's trade. So they are definitely among your top gainers today.
Yeah, I mean, it would look like this is a broad-based rally, you know, if you think about how things are moving, but it's not a broad-based rally. I mean, at one point today, even though the S&P 500 was up more than 1%, you had an equal number of gainers and decliners. It's because, like Carol mentioned, the semiconductors are higher, and then big tech and mega cap tech is just dragging the index higher.
And we should note as well that this is a holiday shortened week. There's not a whole lot of people at work or necessarily trading. Volume in the NASDAQ 100, for instance, is down about 45% from the average.
No, nothing I love more than a holiday shortened week. I do want to say for you, Tim and Scarlett, you take a look at Bitcoin, finally found a bid. We're still below $90,000 a coin, but certainly a good sign when it comes to risk appetite.
Don't forget about our show tomorrow.
I wouldn't. Okay? Every Tuesday.
I thought you were going there. It's at noon Wall Street time.
You're gonna tease. Go for it.
I put that up on a platter for you. You know, it always comes the day after.
Hey, look, it's still down from
ETF
all-time highs of 125,000, right?
There you go. We'll get there one day. Anyway, you take a look at these equity markets, how they're closing on this Monday of this holiday shortened week. And like I said, really a rip higher when it comes to the S&P 500. Looks like we'll finish just over 1.5% higher, 6,700 on the S&P 500. The NASDAQ better there, 2.7% higher on the NASDAQ. The Dow Jones, we keep an eye on that just for posterity's sake, higher by about 0.4%. So again, a lot of green across these major indices, Carol.
All right, and then I'm going to go to the S&P 500. Once again, to the split there. 250 names, guys, to the upside. Scarlett, 241 to the downside, 3 unchanged.
All right, let's take a look at the IMAP. And clearly it's very lopsided because the biggest sectors are communication services, tech, and consumer discretionary. And they are the biggest gainers as well. Communication services, formerly the telecom group, up 4% as a group. Pretty incredible. Tech up 2.5%. Consumer discretionary, which includes Amazon, retailers, home builders, and car makers, that group is up 1.8%. The only decliners are two of the smallest sectors, energy and consumer staples.
All right, guys, let me get to some of the individual gainers. I mentioned semiconductors, definitely on a tear today. They were up, the stocks up about 4.6% in today's session. And then I would just want to highlight a couple of names because you did see a bunch of semi names atop the S&P 500 and I think also the NASDAQ 100. In fact, Broadcom is your #1 gainer in both the S&P and the NASDAQ, guys. It is up 11% in today's session. Take a look at Micron, also a top gainer in the S&P 500. That's good for a gain of about 8%. It too is a top gainer in the NASDAQ 100. Couple things going on. You had Micron price target raised to 338 from 325 over at Morgan Stanley. Has an overweight on the shares. Memory stocks have sold off lately due to concerns about higher capital spending on the view that shortages may be easing, but neither impacts the firm's view, according to the analyst. One other thing I just want to mention, HSBC on Broadcom specifically, just pointing out the company's worked with Google to develop TPUs or tensor processing units for more than a decade. So HSBC adjusting its price target on the shares to 535 from 400 and maintaining a buy rating. So, I mean, just the semiconductors on fire. Speaking of being on fire, Alphabet, I believe this one finished at another record in today's session. It was up about 6.3%. It is up nearly 70% year to date, so easily outpacing the other Mag 7 brethren, if you will. Been on a tear. We talked last week about glowing reviews for its newly released Gemini AI model. And then just to throw in something non-tech, EW Scripps up about 7.5%. Sinclair, one of the largest U.S. TV broadcasters, offering to acquire EW Scripps for $7 a share in cash and stock, marking another proposed consolidation of station owners. By the way, that share price offers 70% premium over Scripps close on November 21st. So a lot of outperformers to choose.
Yeah, easy job finding the outperformers today. I want to start with some of the underperformers. Novo Nordisk down 5.6%. These are ADRs traded here in the U.S. And at one point, they fell to the lowest level in more than 4 years. The company did say that a pill version of Ozempic failed to slow the progression of Alzheimer's disease in 2 late-stage studies. We spoke to Madison Muller on our program a little earlier. She's been covering the industry for years. And the question that she said is, okay, what does Novo Nordisk end up deciding to do? Do they still pursue Alzheimer's as a potential area for this drug, or do they not do another study and kind of abandon it altogether? Also, shares of Copart among the worst performers in the S&P 500, down 4.5%. This is the online vehicle salvage auction company. Shares today touching the lowest since 2023. JP Morgan analyst Josh Potswa lowered the price target on the company to $45 from $50. And finally, Performance Food Group down 2.3%. Shares fell as much as 5% earlier in the session. This after U.S. Foods said it's no longer pursuing a combination with the company. U.S. Food shares rose on the news.
All right, let's take a look at what the bond market did today. Pretty quiet overall, though you did see a bit of a rally develop here, especially when it comes to further out the curve. You take a look at the 10-year Treasury yield, down about 3 basis points. We are still above 4%, a little bit more when it comes to the 30-year yield, down about, you can round that to about 4 basis points or so. Overall, it does feel like when the 10-year yield, where it stands year to date, it just can't reliably break below 4%. I wonder what that means.
Still very much range bound.
Yeah,
when it comes down to it.
Yeah, maybe they're just waiting for that Fed meeting. I was thinking about Mary Daly, another one coming out saying she thinks, we could get, or she supports lowering interest rates come December. I'm trying to keep check of all of the Fed speakers and whether or not we're seeing more momentum when it comes to folks supporting another rate cut.
Well, I guess the question is where's the data that they're looking at? What is the data that they have that is telling them, okay, there are concerns about the labor market? We certainly have the alternative data, but we missed some data when it came to the closure. So, the question is, is the Fed gonna be comfortable with the data that it has to make a decision on December 10th?
Well, soon we'll be in the blackout period, and we won't have any Fed speak, and we'll just have to wait for the decision itself. But just quickly here, we are getting some earnings. This coming out of Zoom. Third quarter adjusted EPS coming in at $1.52. That is better than the estimate for $1.44. In terms of the look ahead, they see fourth quarter revenue at $1.23 billion to $1.24 billion. The estimate had been for $1.23 billion, so the midpoint of that range just slightly above the estimate. You can see the Zoom shares higher by just about 2% in the after-hours trade, Tim.
Well, speaking of higher, Katie.
Okay.
We're going to get to Thanksgiving on Thursday. And
True.
One of the most read stories late last week, we didn't actually have a chance to talk about it with you, was a story about how ahead of Thanksgiving and now on Thanksgiving, instead of drinking wine or other alcohol, people are instead reaching for the THC-infused gummies, THC-infused seltzer, and even, Carol Masser, in some cases, they're actually cooking in THC-infused fats and oils.
It's about Thanksgiving, everybody.
Thanksgiving. You heard it here first.
It can be in the gravy. It can be in the stuffing.
Can it?
And just makes everybody a little bit happier for Thanksgiving.
Or a little hungrier, maybe.
Yeah, that's true.
There's always pies to
choke
eat.
down some more dry turkey. It certainly helps if you have that help.
Wait, spare a thought for the poor wine sellers.
That's the thing. Well, it's part of this broader trend,
Yes.
right, when it comes to alcohol consumption in the United States. You take a look at this Bloomberg News article. Apparently, alcohol consumption in the U.S. is at its lowest level in decades. And we know that Gen Z, for example, is part of that trend as well. So it's the younger generation that's driving a lot of this.
Well, the term for this is California sober, where you don't really touch alcohol, but you are more than open to cannabis and other mind-altering substances that are organic, like psychedelic mushrooms, for instance.
Come on.
Did you know
You've all done the Cousins Walk, haven't you?
The day before Turkey Day is the second biggest day of the year for legal U.S. cannabis sales. That's according to BDSA.
Oh, I thought you were going to say it was the biggest. Oh, okay.
I don't know what you're saying. Some have even started calling it. So there's Cyber Monday, there's Black Friday, there's Green Wednesday.
Green Wednesday.
Everybody goes and buys all the marijuana.
And apparently Green Thursday, too.
I thought you were supposed to go to your hometown bar on the Wednesday before Thanksgiving.
Yes, you are.
That's what the movies told me.
Go back
and
to the movies. All right, what do you guys got for us?
Anyway, so the day after Thanksgiving is Black Friday. So we thought that we would keep the theme going because apparently OpenAI is debuting a ChatGPT shopping research tool ahead of the holidays. So maybe you can get a little bit help and set up a personalized buyer's guide while you're trying to navigate
But are
Black
they going to
Friday.
look through all the reviews and like the promos and all the like junk email?
I would
that you
hope
get sent,
so because I'm certainly not going to.
I've noticed too recently that Amazon has started to have these sort of AI summaries about how people have described the products. They take the reviews and they say, okay, here's what people like, here's what people don't like.
I've noticed that as well. I usually scroll
Ignore
past it. Yeah.
Yeah.
That's my
You're like not interested.
Never read the comments?
Don't talk to me, robot.
Can't you just kind of train it so that, like, you know, your spouse knows exactly what to get you? Can you do that? Like, feed it information?
Mind reading.
Like, think harder, right?
Try again.
Right, try again, exactly. All right, guys, that's a wrap. Across platform, radio, TV, YouTube, Bloomberg Originals, we call it the closing bell. I have Monday brain in a big way. No gummies involved, I promise. Katie and of course Scarlett finishing up there on the close on Bloomberg Television, and Tim and I will continue here on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
Now, coming up, the retail sector in the spotlight this week. We'll break down the health of the U.S. consumer with Deborah Weinswig. She is founder and CEO over at Foresight Research. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. Let's take a look at where markets closed out on this Monday of this holiday shortened week. Quite a bounce back when it comes to the S&P 500, of course. We saw a decline of 2% last week with a ton of volatility. The big index finished up 1.6% higher, and that was driven by big tech. That was the leader on the way down. It's the leader on the way up. If you take a look at the Magnificent Seven, higher by about 3.6% as a group. Meanwhile, the bond market pretty well behaved. A little bit of a rally when it comes to the 10-year, down about 3 basis points on your 10-year Treasury yield. And even Bitcoin found a bid, up about 1.2%, though still trading below $90,000 a coin. Let's take a look at some of the individual movers as well. And we start with Broadcom rallying in a big way because we had good news when it comes to Alphabet. Of course, Gemini 3 leapfrogging its rival chatbots, and you can see that sent shares of Alphabet up 6.3%. Broadcom is the supplier of Alphabet, certainly basking in the glow. Shares up about 11%. And Novo Nordisk, we're taking a look at ADRs there, finishing the day about 5.6% lower after a pill version of Ozempic failed to slow the progression of Alzheimer's in a pair of studies. Meanwhile, we turn to our top story this hour, a high-stakes week ahead for the retail sector as shoppers gear up for Black Friday. A slew of retailers set to report tomorrow, including Kohl's, Dick's, Abercrombie, Urban Outfitters, and Burlington Stores. Now this, as investors await key economic data, including retail sales tomorrow, which was delayed for more than a month by the government shutdown. Deborah Weinswig, she is founder and CEO over at Foresight Research. She joins us now. Deborah, great to have you with us on what is a consequential week when it comes to retail. And I want to start with Kohl's because in addition to reporting earnings tomorrow, we also got the news today that they have promoted interim CEO Michael Bender to be CEO on a permanent basis of Kohl's. And I would love to hear your reaction, what this means for the path forward.
Yeah, I think, first of all, thanks for having me. And this is a pretty tumultuous week, I think, for retail. Yes, the promotion, I think, was expected. I do think you've had so much turnover in senior leadership there that keeping him in that role, I think, is really what the doctor ordered. And they've been, which I appreciate, very open about the amount of technological debt that they have. I think he also understands that. He's very much behind that. And so I think they'll be able to play catch up with some of their peers and also start to, and they've done a great job on supply chain. It's really more around their kind of technological platforms. So to me, that's what I look for in his CEOship. And I think that they absolutely made the right decision moving forward with him.
Yeah, and just for context, I mean, Bender has been on the board of Kohl's since July 2019. He's also worked at Walmart as well as Victoria's Secret. So clearly he has the experience in the space. And given that he has been interim CEO for quite a few months here, to your point, maybe some stability. So when it comes to Kohl's technological platforms, that's something you're looking out for. Talk to us about tariffs. What kind of commentary you're expecting to hear from Bender and the C-suite, and what you would like to hear, and what the distance between those two things looks like?
Yeah, that's a great question, especially as it relates to Kohl's. And since they're multi-brand, right? So they, of course, have their own brand, but they also work with other brands. They're in a better position than some of the other companies reporting tomorrow because they're really able to almost, balance this portfolio of assets from a tariff perspective. And so I think that they'll have had the ability to move sourcing around their own product, negotiating directly with their vendors as well. And so I think that kind of versus some of the directly integrated companies like an Abercrombie, they'll come out on top. But once again, they do have, let's just say, technological debt. And so some of their systems around kind of price elasticity, et cetera, they do have room to go there. But I think when it comes to tariffs, certainly they'll dive deep on that. But I do think they're in better shape versus their peers.
So we're keeping an eye out for Kohl's, also for Dick's Sporting Goods. And this is an interesting conversation because you think about their acquisition of Foot Locker, $2.4 billion. That was back in September. How do you think that that integration might be going here?
I mean, you know, in retail, these things work about 19% of the time. So unfortunately, it is not in their favor, although I think the CEO, like Lauren, is incredibly talented and, you know, has a lot of foresight into what might work. I think Dick's itself has been such an amazing story, whether it's from the technological side or the product side, how their consumers held up, their focus on more technical apparel and footwear. I do always worry about acquisitions like this in terms of getting distracted and you have such a large fleet. So I would say that, to me, the risk is to the downside here.
The risk is to the downside. Well, situate this conversation that we're having, of course, when it comes to Dick's, when it comes to Kohl's, and there's a host of other retail names reporting in the coming days, with the context of the U.S. consumer right now, because there's a lot of worrisome signals out there. But then you take a look at some of the, companies that have already reported, and it's a much more mixed picture. And I wonder where you fall in that conversation.
I'm in the mixed. So I think that we're really reverting back to individual stories. And, you look at Walmart, which now appeals to, right, kind of we have clients of ours who are retailers who have typically kind of focused on, let's call it 100,000 household income and above, and they're worried about Walmart. And so we're seeing kind of some of these companies who've really invested in technology, people, physical stores, and they're really winning here. And I think that has been the Dick's story, just kind of leaning back into that. And then I think, right, we also have Abercrombie and, Urban Outfitters reporting. And when it comes to their customer, right, they've seen really kind of consistency across, right, demographic. I think Abercrombie saw a little bit of weakness in the Abercrombie customer directly, but Hollister has been very strong. And any of those companies, right, that have business in APAC, specifically China, right, that's been double-digit positive territory. So that should also offset any weakness. So I would say that these are individual stories these days.
Right.
And I think the more that you can adjust from a supply chain perspective, I think the better shape you're going to be in when it comes to reporting tomorrow.
Well, I'm glad you brought up Abercrombie, because it is interesting that it's Hollister now that is sort of the shining star of that portfolio. And you think about Abercrombie, I mean, shares are down 57% year to date, which is certainly a black eye. But you think about the past couple years they have. I mean, they were just on fire, 2023, even 2024. What do you think happened there? What is the market not pleased with when it comes to Abercrombie and the turnaround that they've managed to execute?
I think that other retailers is what happened to them. And I think sometimes you can be so insular and focused internally that you're not looking at the competitive landscape. And I think that that's what happened to Abercrombie. And so you've got, going back to Walmart is a great example, but I think you have a picture or portfolio of strength across retail. And yes, of course, they're continuing to do well in certain areas, but it's not everything like it was. It's not Hollister and Abercrombie and all of their markets. And Hollister has really been the winner and Abercrombie's been a bit weaker. And so I think that they're not firing on all cylinders right now. I think they need to kind of pick their head up and look at the rest of retail and think about how they're going to differentiate.
Yeah, looking forward to getting an update there. Deborah, great to preview all of the action with you. That is Deborah Weinswig. She is founder and CEO over at Foresight Research. Now, coming up, economic data ramping up this week. We'll speak with Mark Zandi of Moody Analytics on what to expect next. This is The Close on Bloomberg. Well, it's a short week, but still a week of key economic data releases with September retail sales and PPI due tomorrow, followed by jobless claims and durable goods coming on Wednesday. Mark Zandi, he is chief economist over at Moody's Analytics, joins us now to discuss. And Mark, when you think about the different reports that we're going to see this week, which will you be paying the closest attention to as you try to chart a path forward in this economy?
Okay, we got a lot of stuff coming out, don't we, this week? I mean, we got retail sales, always important because it's a read on the consumer. We've got housing starts, I believe, so that'll give us a sense of what's going on in the housing market, which has been a weak part of the economy. Industrial production, of course, durable goods orders. That's key to business investment, which obviously has been quite strong given the AI boom that's been powering a lot of economic growth. House prices, consumer confidence, I believe, from the Conference Board, UI claims, the cornucopia of data feels pretty good. We're not getting any data for quite some time, so a lot to choose from there. All good.
Well, to that point, Mark, the fact that we're getting this fire hose of data is because we didn't get data for several weeks there, more than 40 days that the government was shut down. A lot of these reports are delayed. So, I mean, how closely can you read into them, given that for many of these releases, they're pretty stale at this point?
Yeah, for sure. This is mostly September data. UI claims will give us a better, more recent read, but this is mostly September. So, yeah, it's pretty backward looking, and, I don't know that it's providing much insight into what's going on right now. But, I'll take it. It kind of, helps us build the mosaic of what's going on in the economy, and hopefully the next few weeks get a lot more data here and get a better read on what's going on. And, it feels like the third quarter, and this data we're going to get this week is related to the third quarter, was a pretty good quarter for the economy. I mean, I think GDP, that's the value of all the things that we produce. That could come in at almost as high as 4% annualized, so that'd be a good quarter. But Q4 is going to come in weak, given the government shutdown. That'll probably be closer to 1. So a lot of ups and downs and all arounds. But I think you're right. It's backward looking, really not quite as helpful. But we'll get more data here soon, I think.
And Mark, I also wanted to talk a little bit about an opinion piece that you published in the Philadelphia Inquirer. I thought this headline was pretty eye-catching. The affordability squeeze. You make the case basically that for a lot of Americans, the lived experience is that prices are super high. And as you say, many Americans are deeply unhappy with their financial situation, Mark. And we're all counting down to that Fed decision. But when you're in this sort of state in the economy where everything feels so expensive, is that something that the Fed can address, or is that something that really requires some government intervention?
Well, Katie, that's coming out. So I gave you a sneak peek on that op-ed. That's my hometown paper. I'm from Philadelphia, and that's my hometown paper. So it's coming out on the affordability squeeze. My sense is that coming into this year, felt like affordability was going to be less of an issue. I mean, inflation was decelerating. It felt like we were headed towards the Fed's target of 2%. Growth was pretty good. So it felt pretty good, coming into the year. But that all changed with the tariffs and immigration policy and deglobalization policy in general. And, that's what economists call a negative supply shock. It both weakens growth and adds to inflation. And here we are back talking about affordability. I think the best way out of this, to restore some semblance of affordability, make life a little bit more difficult, a little bit more easy for low and middle income households, is just to backtrack on the tariffs and on the immigration policy and deglobalization more generally. That's what got us here. I think that would be the best way out. Other than that, very difficult for the Fed to help out here, at least anytime in the near future. In Congress, addressing these affordability questions in housing, healthcare, food assistance, all these things, they're very difficult. Takes a lot of hard work and a lot of time and persistence. So no, I think the only way to improve affordability in any reasonable amount of time is kind of backtracking on the policies that got us here.
All right, Mark, of course, that piece, as you mentioned, coming out, so everyone can go check it out in the Philadelphia Inquirer. Mark, great to get some time with you. Have a happy Thanksgiving when you get there. That is Mark Zandi. He is chief economist over at Moody's Analytics. Now, coming up, the latest thing that Americans are microdosing are obesity drugs. We'll check in on what's going on that market coming up next. This is The Close on Bloomberg. Telehealth companies encouraging consumers to dabble in weight loss drugs that have cropped up in recent months, drawing some scrutiny with popular GLP-1s such as Ozempic and Mounjaro not approved for cosmetic use. let's get more on this story from Bloomberg's Madison Muller. The headline of your story, Madison, amazing. Americans microdose obesity drugs spurred by thin is in blitz. So just to set the scene here, talk to us about what cosmetic use means here in the context of obesity drugs.
Yeah, that's a great question to start, Katie. Thank you. In the context of obesity drugs, obviously, as we've talked about, and as you know, these medications, GLP-1s like Ozempic, Wegovy, Zepbound, they're approved. Ozempic is approved for diabetes. Wegovy and Zepbound are approved for obesity. So when we're talking about cosmetic use, we're talking about people who do not fall into one of those categories, who don't have, diagnosed diabetes or obesity, and who are using these drugs sometimes at smaller doses, microdosing, sometimes at the actual doses that are on the market to lose just a few pounds. And so that's really what we're talking about with cosmetic use, which is something that Eli Lilly and Novo Nordisk have really staunchly opposed with their medications.
Yeah, talk to us about that a little bit. The response from Eli Lilly and Novo Nordisk here. In some ways, it kind of reminds me of compounding because, for example, when these drugs were in short supply, we know that compounding drugs took off, and it almost feels somewhat similar in that this is picking up steam, this trend, but the companies don't really love it.
Exactly. No, that is exactly right. And it goes hand in hand with the compounding. So this is sort of being used as like a workaround for compounders after the shortage ended, because they could no longer sell the exact same dosages of the medications that are on the market. And so they're looking for other ways to sell these medications, sometimes at smaller dosages, to get around the FDA's ruling that they could no longer do this. And so that's sort of cropped up right alongside the compounding and the telehealth. And this is also happening as telehealth is looking for more potential patients. Again, Lilly and Novo have a handle on their supply now. They're also rolling out different direct-to-consumer services like Lilly Direct and Novo Care. And so this is sort of a next peg in the ongoing war between these telehealth companies, compounders, and then the drug makers.
And when it comes to the regulatory side of things, I mean, what has the FDA's effort to crack down on some of these microdosing type offerings look like, and has it been effective?
So it's really interesting. I mean, the last couple of years, the FDA has sort of ignored the TikTok and the social media side of drug advertising. And it's something that is sort of included in their jurisdiction, looking at how drug makers and how different products are marketed. Pharmaceutical companies have to adhere to really strict marketing rules. They can't overemphasize the benefits of their medications. They have to make sure to disclose side effects. But when it comes to telehealth companies and also the way that these companies market on social media, it's a little bit more of a gray area. And historically, the last couple of years hasn't gotten a lot of attention from the agency. Now the FDA is moving into looking more closely at social media, looking more closely at what telehealth companies, how they're marketing on social media, and just generally. And some of these telehealth companies have gotten warning letters from the FDA about how they're marketing GLP-1 drugs, but there hasn't been a ton of follow-up. I mean, they've sent these warning letters and they've said, basically, hey, knock it off. And then there hasn't really been a lot of legal action, regulatory action that comes in behind that. So that'll be an important thing to continue watching as the FDA sort of ramps up its oversight of some of these telehealth companies and the way that they market on social media. But as of right now, it's sort of just been allowed to continue.
Absolutely. We'll keep an eye on how that develops. But Madison, while we have you, you are our resident GLP-1 expert here. So I want to talk a little bit about what we saw with Novo today. Obviously, shares taking quite a dip. That's after a pill version of Ozempic failed to slow the progression of Alzheimer's. And admittedly, this was a long shot study, this pair of studies here. But what does this mean for Novo's ambitions when it comes to Alzheimer's? Are we going to see them basically close the book on this chapter? Or are they going to potentially try again?
It's another good question. I think we have to wait and see. They haven't said much yet about what their next steps are. We know that they're discontinuing an extension of this study that would have gone on for another year. But as for what comes next, not really sure. I mean, like you said, this was sort of a long shot to begin with. A lot of investors, analysts thought this, would provide obviously great upside for the company, but they weren't super confident that this would work. I mean, Alzheimer's is a really, really notoriously tricky disease to treat anyways and to develop drugs for. And there's only a couple of effective drugs on the market as is. So obviously it would have been great if this study worked and if GLP-1s could help with Alzheimer's. But as of right now, the consensus doesn't look great. So as for what comes next, it's sort of unclear, but Eli Lilly is not running studies of its GLP-1 drugs in Alzheimer's either. And that company has a very established and long history in Alzheimer's. So that kind of, I think, reading the tea leaves a little bit, we'll see what happens, but it doesn't look great in terms of this area of study going forward.
Yeah, absolutely. Feels like a little bit of a white whale. Madison, great to get some time with you. Fantastic reporting, as always. That is Bloomberg's Madison Muller. Meanwhile, let's take a look at where markets closed on the day, the first trading day of this week, which, as I keep reminding us, this holiday shortened. Only a little bit longer to go. You take a look at the S&P 500, finishing higher by about 1.6%. We know this has been quite a volatile month for this market, and still for the month of November, down overall for the S&P 500. But at least for today, it was the mega cap companies in the tech space that were leading things higher. The Magnificent Seven as a group higher by about 3.6%. The bond market pretty quiet. A little bit of a rally when it comes to the longer end of the Treasury curve. The 10-year Treasury yield lower by about 3 basis points, still above 4%. And Bitcoin seeing a little bit of action, a little bit of life coming back into Bitcoin, but still below $90,000 a coin. This is the close on Bloomberg. The AI boom shaking up the workforce. Artificial intelligence cited for 48,000 job cuts in the U.S. so far this year, according to Challenger, Gray, and Christmas. Bloomberg opinion columnist Allison Schrager weighing in on the rise of AI, warning of a potential labor shortage. Quote, America is potentially left dealing with a major mismatch in skills and the lack of analytical thinkers with strong math abilities who can use and adapt to however technology evolves. Allison Schrager, I'm pleased to say, joins us now. A fascinating column. So walk us through this thesis a little bit more and how you see this shortage potentially develop.
Well, everyone's very concerned that AI will actually take all of our jobs, but I'm still an optimist that it'll be like other technologies that actually makes you more productive. But that also means we also know from the past that being able to work with technology does require different skills, which means you kind of have to be in some ways like a little bit smarter than the AI, which means, the way especially the technology works is it, looks at a lot of data points in the world and it sort of figures out where most of the data points are. So by definition, that's going to be sort of like a mediocre answer or an average answer, which for a lot of tasks is probably sufficient. But usually what people actually pay you to do is to be a little extraordinary, come up with something new, come up with something novel, or understand the unique context you're in. And AI can be super helpful for that, but it will really sort of need to work with it rather than have it do the work for you. And that requires a lot of sort of analytic skills, often quantitative skills, to be able to sort of go back and forth, to be able to spot when it's not relevant for you or is just lying to you.
Yeah, I think it's a really good point that it truly needs to be used as a tool, not necessarily a crutch. But talk us through, where the math piece comes in. You've mentioned you need analytical skills to be able to basically evaluate the answers that it's giving you. But talk us through how we might end up with a lack of people who actually have the necessary math skills here.
Well, we're getting all these stories about people like really top schools, UC San Diego, even Harvard, coming in, not everyone, but a fraction of them with sort of complete like middle school level math skills. And it's not only, you can't do math anyway, you're at a great university. It also speaks to just a lack of critical thinking and analytic reasoning if you haven't learned that much math. So, it said, to work with AI, I do a lot of math anyway. I find when I'm trying to use it to help me program, to help me analyze data, it doesn't still do that for me. I still need a lot of math skills. And even when I work with junior people, there's still that back and forth. That's still that training. So really to be valuable, to have an AI just not spit out the answer, you're going to need math training because you're going to have to really understand understand underlying technology and how it works and what it's not giving you. And it does seem like it's not just math, but also even like reports of reading and just universities not really sort of pushing critical thinking skills the way they used to.
Yeah, and it is, you could get yourself worried about what this means for the future of the workforce, especially the future of finance, for example, if you have basically a bench of people who don't have those skills and they're in entry-level jobs, and maybe that's okay, but in terms of hollowing out the talent bench of who ascends to those higher up positions, you know, if you're not getting that training, what does that mean for the future of several industries? I don't know if you can answer that question, but...
Well, I mean, the risk is it's a vicious cycle, because if you have a college graduate who's not really trained in how to think critically, then it's like, why hire them if you can get AI to do the exact same job they can? So, I mean, you gain skills not only in university, but really in your first job. Like those first couple years of work is really, I know, where I learned a lot of skills. So if you're not worth hiring, so you're not even really able to think critically, then you won't get hired, so you'll miss another opportunity to learn those skills. And that's when we sort of end up with this hollowing out and potentially no senior leadership.
Allison, great column. I encourage everyone to go read it. That is Allison Schrager. She is Bloomberg opinion columnist and a senior fellow over at the Manhattan Institute. Meanwhile, when it comes to these markets, AI bubble concerns back at the forefront of investors' minds, with KKR's head of real assets warning of froth in the fast-moving markets. Tech stocks finding some relief today from last week's pressure, but it's worth asking why so much of the AI spending hasn't translated into tangible value. For that, let's welcome in Deon Nicholas. He is the co-founder and executive chairman of Forethought Technologies, which develops agentic AI. Deon, it's great to have you with us. So, taking a look at the notes you sent over to our producers, it seems like you're arguing that there is a bubble here that's being developed in AI, but it's in a specific part of the industry. Walk us through that.
Yeah, well, thank you for having me. So when it comes to the bubble concerns, what we're seeing is that there's a ton of investment and a ton of excitement, particularly starting at the infrastructure layer. There's trillions of dollars being spent at the infrastructure layer, and that's all investment in what the future of AI is going to be. And people think this is a bubble in many ways because it's really early to say what's going to happen. On the flip side, all of this investment will start to pan out in the application layer with real AI, particularly AI agents that are delivering value for businesses and their consumers, just like we're doing here at Forethought. And we're really excited about a lot of the milestones that we're achieving.
Well, that's really interesting, Deon, because, you know, you hear a lot of people saying, I want to invest in the picks and shovels. I want to invest in the infrastructure and the things that are, you know, going to power the AI build out. But what you're saying is that when it comes to this build out, that it's possible that, you know, we're building all these different data centers and all these things that go along with that, and potentially there isn't necessarily going to be a use case there.
I think the build out is real, and that's where a lot of the money is. In terms of the use case, though, I actually think there are very many real use cases. So at Forethought, we develop AI agents for the customer experience, customer service particularly. This means helping businesses serve their consumers better. And we've actually just announced $1 billion in ROI delivered to our customers, and that's across lower costs, that's across faster resolutions, and across better retention, customer loyalty, and consumer experiences. So I actually think some of these use cases are truly here and are truly starting to make an impact on real consumers. But where you're investing, it really matters. It really depends on what part of the stack you're focused on.
Well, give us a sampling of the types of clients that you're working with, and, you know, whether there seems to be one particular industry where it seems like the ROI is more tangible.
I think it's actually going to be across the stack. So we work with e-commerce companies like fitness brand Cotopaxi. We work with Lime Scooters. We work with folks like Grammarly, who are AI companies themselves, all the way over to folks like WordPress, Airtable, and Datadog. And so many of these companies, high growth scalers in their own right, whether they're pre-IPO, post-IPO, or scaling even beyond, they're all leveraging Forethought AI agents to develop and deliver better customer experiences for their consumers. And so while we're all thinking about, hey, where is this money going to go? The whole point is, can AI deliver for those billions and billions of people every single day who rely on these products and rely on these services?
Well, a simple question here. Talk to us about how, you know, the modern day AI agents are different from some of the, chat windows that would pop up when you would go to a travel agency site or something along those lines, and people typically bat them away. What is the user experience like for some of these AI agents that you're developing for your clients?
Agreed. And we've all had the really bad experience dealing with a clunky decision tree-based chatbot that's really at the end of the day, very rules-based. And so what I would say is the two big distinctions we're seeing from this AI era in the consumer experience. The first is intelligence, and the second is action. So when I say intelligence, a lot of the old AI chatbots from the past decade, 2 decades or so, have all been programmed using rules, keywords, and what we ultimately call decision trees. In many ways, these were more artificial than they were intelligent. Nowadays, leveraging large language models, leveraging the state-of-the-art technology here, you're getting AI that can reason, can plan, can understand humans, and really take action. And that brings me to my second point, which is action. It's not just about answering questions like, tell me about your refund policy. It's about, hey, can you actually go and issue this refund for me? Find out where my order is, figure out or troubleshoot this database for me, and ultimately solve the problem for me as a consumer. And this is night and day what AI is capable of doing now compared to what it was doing, say, 10 years ago.
All right, Deon, got to leave it there. Great to get some time with you. That is Deon Nicholas. He is co-founder and executive chairman of Forethought Technologies. Now, still ahead, we're tracking Thanksgiving travel trends and what's in store for 2026 with the co-founder and CEO of Kindred. What Kindred's first ever global travel forecast reveals about the state of the consumer next. This is The Close. Well, it is Thanksgiving week, and while some of you probably would swap homes for free this holiday season, our next guest has turned it into a bustling business, allowing people to exchange homes in a newer alternative to hotels or platforms such as Airbnb. Founded in 2021, Kindred now boasts over 220,000 members, with primary residences accounting for about 90% of its inventory. The company is also out with its first ever global 2026 travel forecast. And joining us now on the heels of that is Justine Palefsky. She is co-founder and CEO of Kindred. A lot to talk about here, Justine, but let's start with home swapping. What exactly is it, and how have you turned it into a business?
Yeah, great to be here. So home swapping is a members-only way of enabling community-driven travel. So Kindred was founded in 2021. We launched in 2022. And what we do is we help verified members match with others anywhere else in the world to stay in each other's real primary residences instead of having to break the bank on hotels or short-term rentals. So members apply to join and can either do a reciprocal simultaneous home swap. So I stay in your house while you stay in mine at the same time. Or they can host others in the network and earn nights that they can use to stay at a different member's home at a later time anywhere else in the world.
So who do you compete with? I compared you to Airbnb in the intro, but is that an accurate comparison?
So often when consumers are planning travel, historically, they've had two choices. Either they could stay at a vacation rental or an Airbnb, or they could stay in a hotel. And Kindred is really popularizing this new third option. It's really quickly become the fastest growing new category in travel because of the affordability and the experience that's really grounded in human connection. And as our 2026 global travel forecast found, no surprise, affordability is the far and away top concern of consumers right now as they're planning their holiday travel. So home swapping is a model that really meets this moment by offering a way to travel that is radically more affordable than prior options.
Well, talk to us about how you scale and you grow. It sounds like, you need to attract people to come to your platform with their homes. How do you get the word out here?
Largely through referrals. This is a a high trust experience. It's a really vulnerable thing to let somebody stay in your home. And as you mentioned, over 90% of Kindred members are joining with their real primary home. And the vast majority have never done anything like this before. So what we're seeing is a real shift in consumer behavior because there's such a huge appetite for people to find a new way to travel that can be much more affordable and also more grounded in authentic human connection.
And before we let you go, I am curious, you think about the experience with Airbnb. One of the things that people tend to complain about are these surprise fees when it comes to cleaning or, other little details that maybe were lost in the initial excitement about booking. And I wonder how you handle that and how you handle the homeowners who are offering up their properties.
Yeah, so on Kindred, to book a stay, you just pay Kindred a small service fee. On average, it's between $15 and $30 per night, and you pay for the cost of cleaning. But members don't actually pay one another at all. You don't earn revenue by hosting on Kindred. It's a give-to-get ecosystem where you're essentially just exchanging nights in one another's homes. And so by removing the nightly rate, this makes travel around 10-ish% of the cost of what it would, what you would bring up to stay at a comparable home in a vacation rental.
All right, Justine, have to leave it there. Great to get some time with you. That is Justine Palefsky. She is co-founder and CEO of Kindred. Meanwhile, let's do a quick what to watch in terms of the next 24 hours. We get a whole host of earnings. Pre-market, Kohl's, Dick's Sporting Goods, Abercrombie, Burlington Stores, Best Buy, and Alibaba report before the bell. After the market, we have Dell, HP, Petco, and Urban Outfitters. We also have some economic data, which is exciting, in the form of September retail sales and PPI. And then we get Conference Board consumer confidence at 10 a.m. That does it for us here on The Close. Balance of Power is up next. Have a great evening. This is Bloomberg.